My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Sometimes the analogy fits so well, we just got to use it, if only to teach people what's really happening in the market. Sure, we can use the averages. They tell the tale of some of the day's action. Dow dipping 41 points, S&P declining 0.54%, NASDAQ losing 0.84%. But today I saw something worrisome, something that bothered me. I saw a hammered market, a market where the buyers have gotten drunk as a proverbial skunk, buying the worst of the worst. And when you get hammered, you know there's going to be a nasty hangover on the way. Now, look, for most of the year, this market's been sane, sensible, a sober evaluator of merchandise. And that's why the Magnificent Seven racked up such big gains. Go back in time and remember when they were first running. It was literally one of the worst weeks of the year, when the bank dominoes were falling. The rotation in the mega cap techs made tons of sense. At that very moment, we thought there'd be a credit crisis. Any company with a need to borrow money, a customer base that needs financing, looked like it was toast. So people dumped the banks and any companies that needed to borrow and gravitated to what? They gravitated to Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla. See, these companies spew cash. They're practically ATM machines. Even Tesla, which used to be desperate for cash, but now has a pretty good balance sheet. The Magnificent Seven didn't just appear on the horizon one day out of nowhere. They were selected by a market that was sober, a sober judge of what could survive pretty much any downturn, as it seemed like a recession was suddenly in the cards. But then as we got further away from the mini banking crisis, the market broadened out, and investors collectively got a nice buzz going. You could say the market grabbed a couple of Coronas and took its time drinking them. You can drag these sips out and maintain the buzz without getting plastered. That's a little advice there. Mind you, you can't drive. You can't discern the road like that. But you can buy more aggressive stuff and get a designated driver to take you home. And that's when we decided we could buy the artificial intelligence ancillary stocks like ServiceNow and Adobe, the highest quality techs that didn't make the Magnificent Seven cut. We lapped up cybersecurity like CrowdStrike and Palo Alto. We reached for Eli Lilly because of the chatter about GLP-1 success in reducing weight and treating diabetes. We grabbed AMD and it's an alternative to NVIDIA, glommed onto Cadence and Synopsys, partners NVIDIA. We gravitated to Walmart and Costco, the best of the retailers. And we fell in love with General Electric as a way to invest in aerospace. But not everyone at the party acts responsibly, do they? And some are just not content to be buzzed. There's always some jokers who want to cross the line, and what they want to get hammered. And that's where we are today. The hammered investors have taken over, and they're drinking some sort of Sterno-like punch out of a garbage can. Consider some of the biggest moves today. Let's start with Estee Lauder. Now, this is a company that, regretfully, we own for the charitable trust. Talk about the good ones. This is a bad one. Now, at one time, it was among the top-run businesses in the world, offering the best of the best cosmetics and skincare. Lauder managed to dodge the shrinking department store bullet in this country when huge into Asia, especially China. It made a big bet on Chinese travelers who resell their goods, and it pushed heavily into the duty-free stores. Brilliant strategy until it wasn't. Lauder ran headfirst into a counterintuitive Chinese lockdown that was impossible to game because their government was so irrational about COVID. Meanwhile, Elf Beauty, the discount cosmetics company, came on strong, taking share in some of its best markets. It was a disaster for Lauder shareholders, with the stock down 44% for the year. Today, though, Lauder stock was up 5.3%. What's going on? We can speculate. Activists involved, and I heard that one, takeover, restructuring, heard that too. But I think the buyers here are simply hammered. They're drunk on euphoria and hoping that someone even more intoxicated will take it off their hands at a higher price. Or how about Illumina? Back in the day, Illumina was to biotech equipment as Estee Lauder was to cosmetics. But it missed quarter after quarter after quarter, and the stock got knocked down every time, off 43% for the year. Yet today it was up 4%. Like Estee Lauder, people remember the once great brand, and they think that there's something meaningful going on. I look not at the company, but at the buyers. And I think they've had 3 Manhattans too many. Not long ago, we had Bracken Darrell, the brand new CEO of VF Corp, on the show. He arrived at the apparel business from Logitech, where he had built the greatest computer peripherals company on earth, including some of the finest gaming equipment, one of the best waves worth riding in recent years. Back in July, he left Logitech to go clean up the Augean stable known as VF Corp, a house of brands that fell behind in almost every apparel line, especially its largest division, Vans, the sneaker brand, with revenues down an astounding 22% for the year. When Bracken came on the show, he made it clear there's no quick fix to Vans and told us not to expect one this year. Sober investors would plunge into this punch bowl, which is why VF Corp's down 32% for the year. But buyers were so inebriated today that the stock jumped nearly 4%. You want hammered? How about solar? Wall Street turned on the solar stocks when it became clear they were really more about financing than electricity, because most people have to borrow money to put up these solar panels. Solar Edge and Enphase Energy down 71% and 59% for the year, respectively. But now that interest rates have come down, with the investors with lampshades on their heads can't help but reach for both of them. So Solar Edge, which was just tossed out of the S&P 500 after 2 short years, was up 1.36% today. Enphase rallied 2.2%. These stocks are down so much for the year that there might be a new wave of hammered investors anxious to get in before the party's over. I wouldn't be surprised if these overserved investors go for the post-COVID hard luck losers next. Moderna, Pfizer, maybe DocuSign. Careful, that one reports Thursday. Or maybe the stocks that have been decimated by worries about these GLP-1 weight loss drugs. Consider a company like J.M. Smucker, the packaged food powerhouse that had the misfortune of buying Hostess just before the market decreed that all junk food is fini. The hammered should beware. Smucker reports tomorrow morning. So please wait to sober up with some earnings before you do any buying under the influence. Now, these kinds of rotations are classic tales of a bull market in a momentary excess mode. The sober stocks give way to the buzz stocks, which give way to the hammer stocks. It's time immemorial. And then, of course, the market suffers the inevitable hangover and swears it'll never drink again. You know what that means? We go right back to the dry stocks that got overbought and were just sold by those who drank the most. Many have come down so much, by the way, you can start buying maybe as soon as this week. Can stocks really mirror life this closely? Not really. For example, there's an old adage that says that you should never be the first to arrive at a party or the last to go home. In this fact, it's terrific to be the first to arrive, as long as you recognize that if you're more than buzz, you've overstayed your welcome and have to leave. But bottom line, for those who are slamming them down now and buying stocks under the influence, let's hope they have some designated brokers to help them home. Otherwise, they're going to have some regrets come morning. Let's take calls. Let's go to Scott in Florida. Scott.
Hey, Jim. How you doing?
I'm doing well, Scott. How about you?
Good, Jim. Hey, man, I'm in the hurt locker bad with PayPal, and I'm wondering if, like 60% down with a sizable position. And I'm just curious what your thoughts are, whether I should double down, hold, or sell.
No, I don't want you to double down because I don't like the fundamentals that much. I think that as we get to the end of the year, the tax loss selling will finish, and then that's when you have to sell, because I just don't think that the company has a lot going for it anymore. Let's go to Gary in Texas. Gary.
A big Southern University booyah to you, Jim.
Absolutely.
Enjoying your show.
Thank you, Gary. What's going on?
Hey, I'm calling to find out. I need to get the 411 on a stock, Portillo's. I want to know, what do you think? They're starting to expand, but there are some questions there. What can you hook me up with?
Okay, I like that stock until I saw that these insiders just kept dumping and dumping and dumping and dumping and dumping, and finally I gave up. I said, you can't go for it anymore. It's just too expensive, and they won't stop selling, and that is bad news. All right, for those who are slamming them down now and buying the worst performers under the influence, I think you had a rough morning ahead. Oh, Mad Money tonight. The S&P 500 may be a stalwart, but it's more dynamic than you think. I'm taking a closer look at the latest stocks to join the Howard Index and finding out which ones you might consider for your own portfolio. Then it's not just healthcare stocks that can benefit from GLP-1 drugs. I'm evaluating all the tangential winners from these weight loss drugs, from warehouse producers to apparel manufacturers. And Marvell's shares plummeted after the company saw revenue decline in its latest quarter. So how should investors continue to evaluate this semi-company, especially when it gave kind of a downbeat forecast? I'm seeing where the chips will fall with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.